and welcome to our special webinar entitled Here and Now, Saba Capital's Impact on the UK Investment Trust Industry, where we will be looking at the current situation facing a number of UK trusts following the activist campaign of New York-based Saba Capital. We will be reviewing what this means for the boards of the existing trusts and also how other trusts can prevent future attacks, which are both costly and time-consuming. My name is Fraser Thorne. I'm the Chief Executive here at Edison, and I'm delighted to be joined by Richard Stone, Robert Ogilvie-Watson, and Melissa Gallagher. Richard is the CEO of the AIC, the trade body that represents investment companies and trusts, and he has many years' experience in UK capital markets. Robert Ogilvie-Watson is a partner and founder of boutique law firm Ogilvie and Watchell, which specializes in activism situations, and he has specialist experience of dealing with US-based investors. And Melissa is one of the most experienced participants in the investment trust community, having headed up teams at big names like BlackRock, Allianz, and Gartmore. Welcome. Let's start with you, Richard. If you could give us a little bit of an overview as to how we got to where we are now, and a little bit of outline as to what the current situation is for the trusts that have been targeted by Saba Capital.
Thanks, Fraser. Yeah, I mean, I think it's worth just taking a little step back and looking at, or at least reflecting on some of the conditions that have given rise to the opportunity for activists here, which is fundamentally the sort of widening of discounts that we've seen in the investment trust space. And those discounts now have been at relatively extended levels, probably for a couple of years, partly because of the change in the interest rate environment, partly because of changes to cost disclosure, consolidation amongst some of the investment community, particularly in the wealth manager space. There's a range of different drivers behind that, not least the withdrawal of capital from UK markets, which if you look at the open-ended funds, you've seen, I think 41 out of 42 of the last months have seen capital withdrawals. Clearly in the closed-ended space where you're trading shares rather than withdrawing capital from the vehicle, then that results in selling pressure and a widening of the discount. So it's that widened discount. Now, as the audience probably is aware, Saba Capital Management are a US hedge fund. They have an activist investment strategy. They're very active in the closed-end fund space in the United States, and they've come over here having identified opportunities with the discounts over here. Activists have been a sort of perfectly legitimate and part of the market for many decades, and there are other activists live in the market today who are playing those discounts and making an economic return from seeking the closing of those discounts. I think it's therefore worth looking at just why is Saba different. And I think when you look at their proposals, in the case of the 7 trusts they're targeting here, their proposals are initially to replace the board, so effectively dismiss the existing directors, appoint 2 of their own directors, and we'll come back to some of the issues that perhaps raises later on. But really that's only the start of it, and it's looking at their expressed intent then that follows on from that, not least the desire to give notice to the asset manager to potentially appoint themselves as the asset manager, so they would appoint Saba as the manager of those assets, and to then change the investment mandate and the investment objective of the trusts so that they, rather than invest in the assets they're invested in today, move to invest in other investment trusts at a discount, and effectively become a vehicle, potentially one vehicle if they knock them together, which is then carrying out that sort of hedge funds strategy around the discount and the UK market. So I think it's different because they're looking to make an economic return, not specifically from closing the discount, but from actually taking control of the assets and then putting those assets to work in the market for their own benefit. They'll be taking a fee from the management of that, but also following their own sort of strategy. And I think you can see where that's particularly evident is in 2 of the 7 companies being targeted. Henderson Opportunities Trust, Keystone Positive Change, have put proposals to shareholders, or Keystone Positive Change had done so before their general meeting was requisitioned, Henderson Opportunities Trust as part of their defence, to return capital to shareholders. So in the case of Henderson Opportunities Trust, they're offering 100% of cash back at net asset value or a rollover into a Henderson open-ended vehicle. A traditional activist, that would answer their question. They bought in at a discount, they get their money back at NAV, they've made their economic return from the closing of that discount. That doesn't seem to be good enough for Saba, who aren't supporting those proposals, and therefore that perhaps underlines the fact that here really they're after control of the assets, not just that economic return from the closing of the discount. As I said, it does raise some issues around corporate governance as well, and these are things that we've been particularly looking at, and perhaps in discussion we want to touch on these points a bit further. But I think it raises questions around retail shareholder voting and participation, the extent to which retail shareholders are made aware of the votes and the issues. There is not an obligation on platforms and others to pass on voting rights. I've been really heartened in the case of these 7 companies with the response that we've had from platforms, and I've written to the major platforms as well as to the FCA as part of this process. And I think they have an obligation, because of the fundamental nature of what's potentially going to come to pass if Saba were successful, to inform their customers, regardless of whether they've opted in or out. I think under the consumer duty, in my mind, they have an obligation. But at the moment in law, there isn't an obligation to pass on those proxy voting rights and things to the underlying shareholders. They can, but they don't have to. And I think that needs to be looked at, and the whole sort of issue of retail engagement and retail participation. The other issue is the independence of the board. It's a fundamental part of investment trust governance that an investment company, and it's written within the listing rules, an investment company has to have an independent board capable of acting independently of the asset manager. And that board's only task really is to act in the interests of all shareholders. Their principal economic contract, if you like, is with the asset manager, and they're responsible for that, hence the need to be independent. I think here, where you have proposals to appoint 2 directors to a board with an express intention to appoint a party clearly linked to at least one, if not both of them, as the asset manager, it then raises questions around independence. And Saba have said, and I had a meeting and a very friendly and positive, a very friendly meeting with them, and they answered questions from me, which included, what did they see as in terms of the independence of the board, and they said they would look to appoint other independent non-executive directors. I think it's very difficult to see how anybody appointed to that board, where you're recruited by 2 people who are so clearly not independent, and with an express intent to appoint somebody who is a connected party as the asset manager, could themselves be independent. So I think it raises questions there, which again we've raised with the regulator. I think just to touch, and Fraser, you mentioned it, we're recording this very shortly after the Herald vote was announced. It was really heartening to see, first of all, the very large turnout. I think a turnout over 80% of the shares in issue were voted. That indicates a significant turnout from retail. And it's worth noting that our view is that of the 7 trusts, they all have around or above 50% retail ownership, either direct or through sort of wealth managers. So to have that level of turnout indicates a really good turnout from retail shareholders, which is clearly excellent. And the proposals were overwhelmingly rejected. I think only 59,000 shares, or just over 59,000 shares, voted in favour of the Saba proposals, in addition to Saba's own shares. So over 99% of the shares that were voted, other than Saba's, were voted against those proposals. So a resounding rejection of those proposals and resolutions from shareholders. I think the key message I would get across to anybody else who's listening to this, who owns shares in the other 6 trusts, is don't rest on your laurels and assume therefore that Saba's not going to get any support and this isn't going to happen to your trust. You don't need to worry about it. You've still got time. Get out there and vote. It's really important that you do vote your shares and you engage with what's going on, and you express your opinion and you vote those shares. So that would be my message to anyone who's listening who owns shares in those remaining six trusts.
Richard, thank you. That's very succinct and very neatly put. Can I just ask you, how did we get here to the point that a New York activist is able to mop up so much stock? I mean, he was basically the only buyer in the market. What else is going on in the background as to? I mean, is this is this just happening to trusts, or is this something that's happening wider to the wider equities markets?
I mean, I think there are, you could argue there are some specifics that relate to trusts, but I think fundamentally it's more indicative of what's going on in the UK market. I mean, as I said, if you look at what's going on in open-ended funds, you look at the data reported by the IA or Calastone on, withdrawals from open-ended funds from UK equities, they're really significant, and they've been going on now for the last 3-4 years or so. As I said, over 40 months of consecutive outflows. And in the closed-end fund space, that's selling pressure fundamentally. So I think you've also seen interest rates move, as I said, and you've seen therefore a switch into gilts and bonds away from equities. You've seen consolidation in the wealth manager space and the pension space, which means they're looking for larger, more liquid vehicles, which has kind of hollowed out some of the smaller and mid-cap market and demand in that space. You've seen issues around cost disclosure, which have impacted demand from fund of funds and other investment vehicles that use investment trust, because they're having to pull through, or they were having to pull through an element of cost into their own cost, which made them look more expensive and misrepresented what investors are actually having to pay. So there's a whole raft of different reasons, but I think it's fundamentally indicative of the fact that we've seen a capital flight almost out of the UK towards the US, into the big 7 companies in the US, or big 1 really, in the last year. You've seen that sucking in of capital, and as I said, in the corporate space, it translates into PE and M&A and other activity going on, which is causing a reduction in the number of listed companies in London. And actually, London isn't unique in that experience, but you've seen the listed market shrink. And in the investment trust space, we're not immune from those capital movements.
Well, I think it's true to say as well is that it was sort of slightly reminiscent of the US presidential election, where back in the day with Joe Biden, it was Sleepy Joe, and that the boards have often been referred to as being very idle, I think, and sleepy were 2 of the words that have been used. But actually, the trust industry has been very active in looking at solutions to close the discounts, haven't they?
I was going to say, I would have to leap to our members' defence in the face of that accusation. I think particularly in the last year, we've seen in the last 12 months, we've seen record levels of share buybacks. We've seen record levels of merger activity. I mean, there were 10 mergers between trusts last year, more than double the record for any previous year. There was, I think, nearly 8 billion of share buybacks, again, close on double the previous record for a year, which happened to be the year before. You've seen really substantial number of strategic reviews. You've seen fee changes. You've seen, in a small number of cases, manager switches from one manager to another. There's a lot of activity been going on in the sector from a corporate point of view, all of which is boards being active, trying to deliver value for shareholders and determine the best way to have the most liquid, most attractive proposition for all investors. So I think the idea that a non-exec director on an investment trust board, or the board collectively, is sitting there in some way kind of sleepy or idle is definitely not the case, and certainly not the case as evidenced by all the activity that's been going on in the last year. I think the other point, sorry, Fraser, one point I missed on the why now and why Saba's been able to soak up stock. The other factor I would point to was the UK budget, and I think the way that was handled. Certainly, I've had directors and brokers and others sort of indicate to me that after on the back of the general election, there was a bit of optimism. And actually, if you look at investment trust discounts, you can see this. They came in a bit immediately after the general election. Then there was the talk of the budget and the lead up to the budget around possible changes to capital gains tax, pensions tax, etc. And I think a number of investors, particularly in the retail space, took fright at that, crystallized positions so that they didn't get caught on the wrong side of any capital gains tax changes. And that caused a supply of stock to come into the market. You can see where discounts widened again. There weren't many buyers in the market at that point, and Saba was then able to soak up more stock. And again, you can see how they built their positions in these 7 companies through sort of September into October and November. So I think the timing and the noise around the budget wasn't helpful either in the timing of that.
Yeah. No, one thing that when you listen to the various trusts and Saba is that they're all in agreement that they really want all shareholders to vote. Robert, can I just bring you in as to this? It's a little bit complicated, the process, and when you're voting for a trust versus voting for activists in a company, because another criticism of the Saba approach that I don't think everyone has been perhaps fully flagged is that some people are talking about this as a takeover by stealth. Robert, perhaps could you talk us through a little bit about what are the implications as to the hurdles of what the trusts need to achieve to defeat the motions, and what's the position as to what Saba needs to achieve to be successful in their ambitions?
Yeah, sure. I mean, I guess if we just start at the beginning, if you're a 5% shareholder, you can requisition an EGM, and you can propose a resolution to change the board, to appoint a director or remove a director. And at that meeting, which has to be called within basically 49 days, you've got 21 days to requisition it when the company gets the notice, and then 28 days they have to hold the meeting. And by the way, Saba were very aggressive because, of course, they did this just before Christmas. So they kind of took advantage of the holiday period. And then at that meeting, you need 50% of those attending and voting. And of course, if you've got a shareholder like Saba with a large block, if there's any shareholder apathy or failure of a turnout, their shares have a sort of a weighted influence at the actual meeting. So in terms of the vote, I mean, it's not necessarily different for investment trusts, although investment trusts tend to have a larger proportion of retail. And I think up to about 30% in some of these are retail investors, and they tend to hold through these platforms. And a lot of them opt out of voting on or being notified about a vote coming up, certainly for sort of routine matters like AGMs. But when you get something like this, which is a sort of corporate transaction, what you can do is you can get the platforms to actually treat it as a corporate transaction and then put push notifications out to people on these retail platforms to say, here is an instance where we think you should be interested to vote. So there are ways of maximizing votes in this kind of situation. For the institutions and the sort of wealth managers, they're probably much more likely to vote, and the company's got a more direct contact with them. They know who they are. So they tend to be more active in voting. There is a sort of slight side point here, which is I think the effective stamp duty does cause many institutions to actually hold shares using total return swaps in order to avoid paying 0.5% stamp duty. And I think that can sometimes influence, the vote, because unless you're the actual registered shareholder, you don't vote the shares, because if you're doing a total return swap, it's going to be held by the counterparty to the return swap. So there are a few sort of vagaries in the UK market around how these votes get cast. Another thing here, which is quite interesting, is I think I'm right in saying that Glass Lewis and ISS, the proxy agents, have generally been supportive of the boards. And that's not really surprising given the corporate governance issues we heard earlier about, removing a board and then just putting in place 2 directors and then letting them assemble the board later, which is what Richard mentioned. So I think it's quite helpful that the proxy advisors have been supportive of the trust here, because many of these votes get cast on their platforms and on these platforms, and those platforms tend to default to vote in accordance with the advice from the proxy advisors. So there's quite a lot swirling around to do with the voting. Another thing that companies can do is they can send out what are called Section 793 notices, where you get a list of the underlying beneficial shareholders. And some of these trusts have been doing that, and that then enables them to send a notice directly to the shareholder saying, hey, there's a vote coming up, it's important, put more information on our website or talk to your platform through you hold the shares and vote on it. So I hope that answers your question, Fraser. There's a lot going around about the voting.
Thank you. And Richard, the idea, there is something unusual, although this is an activist approach, and you can look at the classic playbook and everything else, and there's a lot that's there. But there's actually slightly unusual that I don't think if I was just an average trust holder, you might not fully appreciate that it's a takeover by stealth if Saba wins everything. Can you just talk through a little bit more about that? Because then what you're then left with a holding in something that might have a completely different investment strategy to the one that is appropriate for your own personal needs. I mean, you might have bought the Henderson Opportunities Trust, for example, because you're taking a 10-year view on smaller companies outperforming. The fact that they just hit a smaller, a more recent blip. I mean, So what is the takeover by stealth and why that is?
I mean, the takeover by stealth is linked to the point I was making earlier that as Robert said, the resolutions in front of shareholders at the moment are to simply replace the board, but it's the stated intention of Saba after that is critical. And they've said they want to appoint themselves as the asset manager and change the investment strategy and mandate effectively to invest in other investment companies. So, if you invested in Herald, and let's pick that one because we now know the outcome of their vote. But if you're invested in Herald, you probably chose it because you want to be exposed to smaller cap tech companies, some of the great companies that are going to be the future of economic growth and innovation and all the rest of it that trust has been investing in for many years. If you hold the shares in Saba had won and then changed the mandate, actually you'd find yourself invested in a vehicle that was investing in other investment trusts, was paying a fee to Saba for that benefit, which actually they haven't disclosed what that fee would be. That's going to have a very different risk and return profile to the assets you're currently invested in and you've chosen. You may well have chosen to invest in Edinburgh Worldwide because it's got a stake in SpaceX, and it's a good way as a retail investor to get some of that exposure, but within a bit of a diversified portfolio. I know Saba said they quite like that holding, so they might not get rid of it. But it's the point is you've invested in an investment trust because you buy into the thesis and the mandate. I accept that it might be a painful experience as discounts have widened in terms of performance in the short term, but actually these are long-term investment vehicles, and you're particularly where you're investing in relatively cutting-edge technology and smaller businesses like Herald is, then that's a long-term enterprise, and so to be shifted into a vehicle effectively which has a completely different investment thesis, is investing in completely different stuff, is a total change from where you were originally, hence the sort of takeover by stealth point that you make.
Yes.
I mean, I think the key point is that, just picking up one of the things that Robert said, because I used to run a platform. The platforms, as I said, don't have to offer shareholder rights. Many of them you have to opt in as the customer to receive the information. Only Interactive Investor at the moment opts all of their customers in, and you have to opt out. And I think as a reflection on all of these meetings and this process, I think how shareholders are engaged with how that process works, the extent to which shareholders are informed. I mean, there is still bad practice going on in the market where some platforms are not passing through proxy voting rights. I've seen one where it's in their terms of business that's the case, for example. Others where they're charging shareholders to vote or their customers to exercise their votes, which again doesn't feel right to me that you should be charged to vote because you happen to use one platform rather than another. So yeah, there's a number of issues there which I think need addressing. Although, as I said, I would reflect that I've been heartened by the response of the major platforms in this particular case, and I think you can see that evidently in the turnout numbers on the Herald vote.
Yes. Sorry, Robert, did you want to add?
Yeah, I just wanted to add. It's interesting because the takeover code will apply to these companies, and under the takeover code, you have this concept of a board control-seeking proposal. And a board control-seeking proposal is where you propose to change all or the significant members of the board. And here they are trying to do exactly that. But you don't trigger a mandatory offer unless you also buy shares, which take you through 30%. So in Saba's case, they built up to no more than 29% in some cases. They then would have put a stop notice so that neither their fund nor anyone connected with them would buy any more shares. The fact that they've got a board control-seeking proposal is not in it a takeover proposal under the takeover code, because even though they're proposing to change the board, they're not actually buying any shares. So it's quite an interesting little loophole that they're exploiting. And in a sense, they're not doing anything wrong, but it's one of the vagaries of investment trusts that you have non-exec directors, and then you've got the investment manager, who's effectively like the executive of a traditional company. And a proposal to change the investment manager is not regarded in the same way as a change of the board. And it's one of the sort of areas where investment companies governance doesn't quite work. And, there have been some criticisms of investment companies that you have board directors, non-exec board directors, and Richard, if any of this is offending your industry, I apologize. But they tend not to be full-time roles. They tend not to be, certainly on the smaller trust, particularly well paid. And they are very much kind of beholden to the investment manager, who really takes the investment decisions, reports up to the board. It takes a pretty brave board to completely question the investment manager's day-to-day decisions. Their only real defense against a poorly performing trust due to the manager would be to change the manager. And many of the investment management contracts have quite severe poison pills for changing out a manager, and may take up to 2 years before they're changed out, and they continue to get certain fees. So there are aspects to how investment companies are structured that does invite this sort of action by Saba.
Yeah, I mean, I think we've seen, I think that's changed or is changing. We've certainly seen an increasing number of boards willing to change the asset manager, and also to contemplate mergers with other funds from other investment management houses and things. So yeah, that's definitely happening. I mean, Saba highlights in their the seven trusts the notice period that they would have to give to the management groups, and that does vary. I think a year was the longest, but it is happening a bit more from time to time in terms of the board expressing that independence. But you're right, they're not full-time roles, and so it's not the same as having executive management sitting there. I think one of the key points is that the change in management contract doesn't require a shareholder vote. So the board, once appointed, could appoint, subject to the issues of independence, which I raised earlier, the board could appoint a different asset manager without recourse back to shareholders. So the ability to take over the economic interest in that one major contract that the board has within its gift is that makes it an investment trust, I think, very different from a trading company, where if an activist investor comes along to a trading company, the ability for that activist investor to take control of the board and then take control of effectively the assets of the company for its own economic benefit is not the same as it is in an investment company, where you have effectively everything resting within that one major contract.
Thank you. Yeah, correct. Melissa, can I just bring you in, because you sit in a very special place within this panel, is that you have sat within the asset management community, you've sat within the heart of the trust community with the Alliance. What's a couple of things? One is, we talked about supply and demand, and that's an issue with all equities, but certainly within the trust space, is that what else can trusts do? Buybacks, I think, are simple but a bit blunt. Trouble with a buyback, as I've often pointed out, is that they're one-off events. Okay, they might run for a series, but they're still a one-off event that you can't. You're trying to model something, you can't create a discounted cash flow of potential future payments against it. So they lose a lot of future benefit, although there's an opportunity. But what else do you think that, what are your thoughts on the situation? I guess what's going through the board's minds at the minute, and what can they do in the future to prevent these kind of situations?
Absolutely. I mean, just taking a step back from myself. I mean, I've been in the industry for the investment trust industry for almost 25 years now, and I think this is probably one of the most significant events that I've seen. And it's almost like a perfect storm has happened. You've got obviously the whole sector's being squeezed. You've got a number of duplicate, less well-performing subscale trusts. You've got the increase in the private investors are holding shares via the platforms, and then obviously you've got the Saba. So you've got all these ingredients, and it's producing this perfect storm as such. And obviously what we've seen with these 7 trusts, and Saba, requisitioning meetings, etc. It's kind of, this is an industry where I would say that these tactics are very aggressive, and given their lack of detail in the high level proposals that they've put forward, it's shaken an industry where strong corporate governance and the importance of acting in the best interests of shareholders is absolutely key. And so I think in terms of what boards can do going forward and what the industry can do going forward, I actually think it will be, I think what we're going to see is the survival of the fittest. And actually, I think we'll see fewer number of investment trusts, but they're going to be larger in size. And going back to the point that Richard made earlier, I think it's really important to point out that actually we've actually started to see this over the last year or so. And we've started to see this play out as an unprecedented number of boards step up and take action. And I think there was, going back to the point that Richard made, there was £7.4 billion worth of buybacks compared to 3.9 billion of share buybacks in 2023. And with the mergers and the wind downs, in fact, 24 companies left the sector in 2024. So a lot is happening, and so. But I think that momentum's got to continue, and I think those trusts which are on wide discounts, primarily in the conventional equity trust, because I think they could probably move quicker than those which have got more liquid assets. This is an opportunity for the boards to get on the front foot and pose the question, does their trust as it currently stands deliver value to all shareholders? And I think, when you look at what they need to look at, how is the trust performing? This is not just against your immediate peer group of immediate investment trust peer group. It's against the open-ended side. It's against the active ETFs that we're seeing coming through. I think it's also important for the boards to look at, does the trust have a differentiated strategy? Again, against its immediate peer group, but also against the other active ETFs and other fund structures. Is the trust taking advantage of the unique features of investment trusts? Are they using reserves to smooth out the income? Are they paying income out of capital? Are they gearing? They need to look at, is the trust the right size? The larger trusts, as you know, have reduced expense ratios and are more liquid. And so they need to be large to attract the larger wealth managers. So if they're not large enough, the question needs to be asked, are there trusts out there that they could merge with? Going back to the point that you raised, Fraser, about buybacks, I think boards need to look at, does a trust have a discount policy? What is it? And again, when you're not just comparing yourself to other investment trusts, you're comparing yourself to a much wider space, which now includes active ETFs as well as open-ended funds. So if you look at the active ETF space, they have quite a few benefits of the listed structure, but they don't have the discount risk. So I think directors, boards have to look at, okay, well, how can we minimize that discount risk? Should we be doing it by share buybacks, or should we be doing it through frequent exit opportunities, for example, any ways which we can keep the discount narrow? And again, there's other aspects that boards I think should look at, how competitive are our fees, not only against within the investment trust space, but the wider market space. And also what quality and what is the quality of the reporting to all our investors, particularly retail investors? And this is something which I'm very passionate about in terms of, are frequent research notes being written? Are there brief podcasts updates being done? Are the retail investors who are holding their shares via the platforms being invited to attend to vote at AGMs and other meetings? And this, we've talked about this earlier. Are managers speaking at seminars? How informative are the fact sheets as well as the annual and interim reports? Is there an effective PR program? And I would just add that the last area, or one of the final areas that I think the boards should also look at, are they making the best of good corporate governance? I have to say, and we've touched on this earlier, the independent boards of investment trusts are streets ahead in terms of governance when compared with other fund structures. So, but it's still important for boards to consider to what extent the board has diversity of thought, diversity of experience, gender and background, and are new NADs being appointed by a rigorous recruitment procedure using independent third-party advisors. So I think there's lots the boards can do, in terms of making sure that they deliver value to all shareholders. And I think if boards can tick a lot of those boxes, or majority of those boxes, then I think they could confidently say we're delivering value to all shareholders.
Can I just add to that, Melissa? I think the one message I try to get across to our members as well is, the share price and the net asset value, yes, they're related, but there's no divine process that says they have to move in sync with each other or whatever. The share price is really a fundamental function of supply and demand for the stock and sentiment towards the underlying asset class, and is arguably separate from the performance and things that can be delivered within NAV by the asset manager. And I think the boards need to think about, and you touched on this a little bit, how they communicate with investors, how they tell the story, how they bring that story to life, to what extent are they talking about the companies that they're investing in within their portfolios, what's their digital strategy, do they have an online presence, are they on LinkedIn or X or wherever, what's their digital footprint, as you say, how easy and regularly are they communicating out to shareholders? It's you can't just turn up at shareholders when there's a problem and ask them to support you if that's the first they've heard from you for X number of years. You've got to be finding ways of communicating, and the supply and demand, quite often a lot of emphasis is put on the demand side of that. Where's the marginal shareholder, where's the marginal buyer coming from, what should I be doing to market the trust, but don't neglect the supply side. Your investor relations piece, the making your existing investors happy, keeping them bound into the investment thesis and mandate and what's going on within the portfolio, and keeping them engaged and interested. If you can stem the supply of stock, that helps just as much as finding somebody else to come along as a buyer. So you've got to treat both sides of that equation. It's not just about continuously trying to find, where's the next marginal buyer coming from. Your existing IR and keeping your existing investors happy is a key part as well. And that comes back to Melissa's point around, shareholder comms and the fact sheets, and making sure that you're providing access to your fund manager, doing vox pops, little videos, using different media, all the rest of it, to keep that story in front of investors, so that when they look at their portfolio, they don't think, oh, I haven't heard from them for ages, I'm not quite sure what's going on there. Performance looks a bit flat. Oh, I think I'll get rid of that one. It's that kind of, you've got to find ways of bringing the story to life and telling the story to people, and that's both existing investors as well as new.
Melissa, can I ask as well? Richard touched on other influences and how the government can impact on things, and we've talked a little bit about regulation. One of the things that slightly strikes me as strange is that how little data or connectivity a lot of the trusts have and the asset managers have with the underlying shareholders. Why is it so difficult to build these databases? And has everyone got sort of feared into GDPR worries that really aren't there? Why are they beholden to the platforms in such a way? Because it's very expensive to have to go through this exercise to get everyone to vote. When
it is.
You should be able to talk to your shareholders one-to-one. What is so complicated about the process?
I mean, Richard maybe given that Richard used to be on a platform or managed a platform, he's probably more afraid with this. But I think with the with private, I think we're still in quite early stages yet, because with the increase in platform ownership, particularly over the last 10 years or so, following the retail distribution review, I still think a lot of the platforms are playing catch up, and as Robert said, with the Section 793. a lot of the trusts that I used to work with, they spent, it is expensive, it's an expensive exercise, but a lot of them, prior to the annual report going out, they did a Section 793 and got the names and addresses of the underlying holders so that they could write to them with to say that the annual report is now available and would you like to attend the AGM? Now, obviously the cost of that depends on how many underlying investors there are on the register. Hopefully that cost will come down, but with, as you say, with GDPR, but also with investors going off the register and coming on the register, it's likely that it needs to be done once a year. So therefore you've got an ongoing cost.
There is another problem with that, which is that if you send out a Section 793 notice to find out who the underlying beneficial holders are, that gives you a snapshot at one moment in time. And then the register can change. So there needs to be a way of having a more direct access to the underlying investors. The other issue I've come across is the custody chains are very complicated these days. So, holding via nominees and intermediary banks often makes it extremely difficult for people actually to vote or get their votes cast, because especially in an activism situation where you want to actually proactively get out there and vote, often it's quite a complicated process to do that, particularly if you don't want to just go down the route of just automatically voting according to the recommendations that may be on the platform. You've got to actively, tell someone to do something different to what they're hardwired to do automatically. Yeah. So there are those two. I mean, if you could find a way of getting a direct access to the underlying beneficial holder and knowing when that beneficial holder has sold and who's bought in, and so you have a sort of dynamic register with a contact point, that's what's really needed and is what's completely missing at the moment.
I think there's a couple of points I would make here. One is Melissa's right in saying that this is still relatively early days with the platforms. A lot of the asset managers used to have direct savings schemes into their investment trust books, and they therefore had that direct relationship. Or investors pre-platforms used to invest and buy their shares through their bank or whatever, and they would hold a paper certificate, and therefore their name would be on the register, so you'd have that direct relationship. The growth of the platform space has led to that relationship between the investor and the company being intermediated, and that therefore, as Robert says, creates that chain where you kind of have to get through that somehow. I think I am seeing quite a lot of the asset managers now progressively building, and the companies individually building their own mailing lists where you can ask an investor whether they would like to receive information about your company and to sign up, and you provide them with all the usual unsubscribes and everything else at the bottom of the emails. Whether or not they're still a shareholder, were a shareholder, or thinking about becoming a shareholder is kind of less relevant. You've at least got their contact details and their consent to contact them regarding that particular trust or a asset manager's range of products or whatever it happens to be. So I think we are seeing a proliferation of those sorts of databases being captured and investor contact details being captured. But again, I would say that's in its relatively early stages. The only other point I would make, and this comes back to a point I made in my sort of opening remarks, is retail investors need to be careful they don't get caught out by timelines as well, because part of the function of the chain that Robert was talking about is that the deadlines get shorter and shorter as you go through the process. So part of what Saba did by calling the general meeting in week before Christmas, that can, and on a condensed timeline means that the meetings are happening, as the Herald one was today. You've got 5, I think, in the week of the 3rd of February, and then the Edinburgh Worldwide one is a little bit later. But the deadline for voting is significantly before that. So for Herald, if you're a retail investor through a platform, certainly the major platforms, the voting cutoff was last Friday. Mm-hmm. So don't think you can leave it till the day of the vote or the day before, or even in this case, the weekend before. Mm-hmm. You needed to have voted by last Friday in order to have your vote registered. So just be a little bit careful of that as well, because the platforms have to collate their votes, then they have to submit them through Quest and stuff. Without getting too technical about it, there's a whole processes that has to go through. So, investors can see this and think, oh, there's a general meeting on the 22nd, I need to vote my shares. Well, yeah, that's fine, but actually you needed to vote your shares by the 17th. So don't get caught out.
Can I thank you? We're sort of coming up to the time of allotted for this recording, and just wanted to, firstly, thank you all, Richard, Robert, Melissa, for your fantastic insight and input into this. I mean, we could almost run one of these each day, given everything that's going on, and maybe we'll make a feature out of this. But the 7 that the Saba's are currently campaigning against is just the tip of the iceberg. I think he's got holdings in at least another 20 that I know have been named. But just as a sort of roundup, perhaps across each of you, what 3 things would you be advising to those boards and beyond those 20 or 19? What 3 things would you be advising them to start looking at? What's sensible housekeeping to make sure they don't get caught out, and to build relationships with their investors? Melissa, maybe I can keep that one to you first.
Actually, sorry, could you give it to Richard?
I'll take it first if you want. Yeah, no. I mean, I'd keep it very simple, Fraser, and I'd say 2 things rather than 3, I think. And one of those is probably for all trusts, and that is around, really picking up the points that Melissa was talking about earlier in terms of looking at your discount, your marketing, your discount control mechanisms, what you're doing there. Now that's easy to say. It's difficult in some cases, particularly where you have illiquid assets within the portfolio. You can't stand behind a discount control policy in the same way that a liquid equities portfolio can. So you need to be thinking about what measures you're taking that limit the scope for activist participation. I mean, that said, the less liquid assets within the portfolio are less attractive to activists anyway, because the ability to close that discount by realizing those assets at NAV is less obvious. So, but I would say, a real kicking the tires on what you're doing as far as discounts and that side of things is one part. And the second part then is your marketing, PR, IR strategies, and what you're doing there in terms of keeping investors informed, telling the story of the trust, making it relevant to investors, bringing it to life for people, communicating with your existing investors as well as new. Don't neglect that part of the puzzle. And don't leave it till there's an activist taking action. And I'm certainly not saying these 7 did, but don't leave it until you're then coming to shareholders cold. You need to be building those stories, building that relationship, and so focus on discounts, focus on the marketing, the IR side. Those would be my 2 key points, I think.
Thank you. And what would be your advice to boards, Robert?
Well, I absolutely echo what Richard said about all of those things. I would say one other thing, and this is slightly provocative, especially for the smaller ones. I would really examine whether you should continue to exist. And I mean that in the nicest possible way, because I think there probably are too many investment trusts, and I think some of them are subscale, and some of them maybe have a greater exposure to private investments than public, which makes some of the reaction to what's going on quite difficult if they're quite illiquid holdings and they end up being quite high in a proportion of their overall holdings. Yes, there were 7 mergers in last year, Richard. I think probably there should be more. I know of at least one client I was talking to that was considering setting up a consolidation vehicle in order to consolidate a number of trusts. So what Saba have done has been pretty brutal and agricultural. I think they've probably done it the wrong way by targeting 7 all at the same time, all of whom probably needed slightly different messages. And I think a lot has been lost. But I do think structurally for the industry, it is worth each of the trusts really considering, are we subscale? Is there something we could do? Should we merge? Because in a sense, in addition to the 2 points Richard made, that might be a very strong defense to really question your existence. And are you sort of set up with the right proportion of holdings? And is there another trust that's similar you could merge to and bring costs down?
Do you think all trusts should sort of be forced to go through continuation votes?
I think it's a useful discipline, actually. A lot do have continuation votes. I think it's a pretty useful discipline. I'm not saying it should be mandated, but it's a chance to really reflect. I mean, some trusts in-house the management themselves. Some bring in a new manager. some should question their size and the overall proportion of listed versus private investments that affects their ability to react and do some of the steps that we've talked about to narrow the discount.
And I think you do have to consider, if you're a trust that's invested in real assets, illiquid assets, you might be invested in, renewable energy infrastructure or whatever it is, those assets are not readily realizable. So if you vote for discontinuation, actually you're then immediately telling the market you're a distressed seller, distressed in sort of brackets, but you're a known seller to the market. That's not necessarily great for realizing the best value for investors. So I think you've got to be, again, the prescription probably varies depending on the trust and the nature of the assets it's invested in. But the board's responsible for delivering in the interests of all the shareholders and delivering value for those shareholders. And that's really the question that I think Melissa and Robert are highlighting. So
Melissa, leaving the best till last, what would be your advice to the boards right now? If you had two things to say to a board that's worried about what might happen next with Saba if they turn their guns on them.
Well, I think adding to the points that both Richard and Robert made about, the discount, the communication, are they subscale? Is the scale right? I think it's about, do we have a differentiated proposal strategy to everyone else's, which is, who's out there. And it goes back to the point that I've raised a couple of times. It's not just within the investment trust peer group. It's the broader marketplace, because you're seeing more and more active ETFs coming in. You've got the open-ended side. So I think ultimately each board needs to look at, what is our purpose? And that includes all the various points that we've discussed today. And I think, if they can confidently say, this is what our strategy is, this is what we stand for, this is our purpose, we've got the right manager, we've got the right discount management policy in place, we've got the right board, then I think, and absolutely the right marketing, the communication, then I think, if the boards, the directors can tick each of those boxes, then I think they're in a good place going forward.
Excellent. Thank you. That's really, really interesting to hear from all of you. Thank you very much for your time. And with that, unless anyone else has got anything that they want to add, well, actually, Richard, maybe I'll let you. I'll give you the last word on the. What's your call to action for investors?
I think I've probably said it a few times already. You've got meetings coming up, the 3rd, the 4th, the 5th of February, and then the 14th of February. I think, please vote your shares. Pay attention to what's going on to your investments and vote your shares. Be engaged and be active as an investor. That would be my final call to anyone listening.
Excellent, thank you. I think we all echo that. People are working very hard. You work very hard to get that to earn that money to invest, and now you should take responsibility for what happens next. Thank you all very much for your time. That was fantastic conversation. And with that, I will close this meeting and say thank you and goodbye.
Thank you.
Thanks a lot. Bye.